it never occurred to me that I could be on the other side and be an enabler. When I step back, it's a different scale of impact, right? I'd worked with, mentored scientific entrepreneurs my whole career, maybe my whole life if you throw my family in the mix. And I feel like I can connect to them in ways that maybe a traditional business-focused VC cannot.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Green Bay Packer descendant himself, Eric Hornung.
Ooh, with the question mark there. That was pretty nice.
Are you related to Paul Hornung?
I get asked this question a lot, being down here in Cincinnati, talking to a lot of older guys who remember the Golden Boy. And with him passing away this year, I think it popped up even more. If I'm going to tell you the truth, I don't think so. But, and here's where the but comes in, Jay. My grandpa did make a on paper in the garage family tree once, and somehow on there was a Paul Hornung who would have been about Paul Hornung's age. Now, that's pre-ancestry.com. That's there's a lot of room for error on that chart, but I'll take, a maybe. That's all I'll cash in for there.
He was born in Louisville, Kentucky.
He was born in Louisville.
It's not super far. I'm really impressed that you knew his nickname was the Golden Boy. I didn't know that until looking at his Wikipedia page right now.
Yeah, that's off the top of the dome knowledge right there. When you have the same last name as someone, you tend to learn a little bit about them just over time because you have to. It's really a forced habit.
I'm just trying to learn a little bit about your heritage, Eric. I want to know a little bit more about who you are related to, descended from. I think our heritage is something we should honor.
I think so too. Mine is you come through New York City, I think it's where everyone showed up. And somehow every single Hornung in the country ended up in Buffalo, I think at some point, and then dispersed from there. So if you ever go to Buffalo and meet a Hornung, chances are I'm related to them. That's my heritage, Jay.
The downside is, if you're going to be descended from Paul Hornung, now you have to live up to the life that Paul Hornung led.
And he led a great life. Some would say he led the one life that he had the best way he could. So he would have got along great with our friends at Ethos Wealth Management. And you can go to upside.fm/ethos to learn more.
Well, speaking of heritage, Eric, today we are speaking with Ginger Rothrock, a senior director for HG Ventures. HG Ventures supports innovation and growth across the Heritage Group by investing and partnering with private companies, developing new technologies and approaches in both their core and adjacent markets. Eric, the Heritage Group was founded in 1930.
Good year.
Good year. Very good year. It's a fourth-generation family-owned business managing a diverse portfolio of more than 30 companies specializing in heavy construction and materials, environmental sciences, and specialty chemicals. Back on the large, privately owned company train.
This is just like some good old-fashioned Midwest business right here.
Good old-fashioned Midwest business. This is going to be really fascinating, I think. HG Ventures, akin to kind of a corporate venture capital arm for the Heritage Group. And we have lots of questions for groups like this, Eric. But this goes one step further because HG Ventures is now supporting a Techstars Accelerator in Indianapolis, Indiana, bringing in companies in this world of heavy construction materials, environmental sciences, specialty chemicals. Sounds like a really interesting and unique opportunity for companies in those industries.
I want to give a quick shout out to Haley Keith from Mito Materials, who's been on the show. She introduced us to Ginger 2 years ago, Jay, and we are finally getting this up, running, and I am stoked about talking hard tech here on the Upside Podcast.
Stoked. Before joining HG Ventures, Ginger served as Vice President of Technology and Commercialization at RTI International, one of the largest contract research organizations in the world. In that role, she oversaw the commercialization of more than $1 billion of portfolio R&D and served as a mentoring coach to numerous scientific innovators. I'm going to be way out of my scientific periodic table of the element here, Eric.
But you're Mr. Creative Elements.
Ah, you're right. You're right. I got to rise to the occasion. I got to rise to my heritage. We'd love to hear what you think about this episode with Ginger. You can tweet at us at UpsideFM or email us hello@upside.fm, and we'll get to that interview right after this. Eric, we got to make some big changes to how we do operations here at Upside.
This feels like an intervention, Jay.
It's a bit of an intervention. I have to give you some tough love. We've had some calendar problems over the last couple weeks.
I've had some calendar problems. You don't have to throw the third person on this.
I do like to take the blame for you, but this one is on you. And Eric, I think we have found a solution to our calendar and scheduling problems.
But there are 101 scheduling tools out there, Jay, that can help you avoid the awkward dance of finding a time to meet.
But this tool is by far and away the best one I've seen, and I have looked at a lot of scheduling tools. And I am talking about SavvyCal.
SavvyCal makes it a collaborative effort, allowing you to personalize links and allow recipients to overlay their own calendar on top of yours.
It's going to make booking guests for Upside and even just one-on-one conversations a complete breeze. You got to see what this looks like. You got to see how it works, because you're going to ask, why wasn't it always this easy?
You can sign up for a free account at savvycal.com/upside. That's SAVVYCAL.com/upside. And when you are ready to test out a paid plan, use the code UPSIDE to get your first month free.
This episode is sponsored by Fundboard. Fundboard is a free tool to help you find startup investors and manage your fundraising process. Fundboard helps you to find not just the right firm, but the right person at the right firm. Fundboard makes it easy to search, save, and share. You can search thousands of investors ranked by how well they match your startup. You can save them to your Fundboard to create your list of targeted investors, and you can share your Fundboard with your network to game plan how you'll approach investors directly. You can build a tailor-fit list of startup investors in minutes with Fundboard, and you can learn more at upside.fm/fundboard. That's upside.fm/fundboard, and the link is in the show notes.
Ginger, on Upside, we like to start with a background of the guest. So can you take us on a quick rocket ship through your history?
Sure. So I grew up in an entrepreneurial family, not the type that you guys interview or I fund, but the type that takes a second mortgage on a house to launch and grow, right? My dad, my uncles, grandparents, engineers, contractors, small business owners. I grew up in the brick business, rural Tennessee, hanging out the brick plant, running copies of blueprints, but really, seeing the hustle and hard work and the correlation between your own efforts and the rewards, right? Embracing risk. So I grew up with risky household, right? And the downside, right? I had years where I ate a fair amount of Spam, but I went to undergrad in Furman in South Carolina to pursue chemistry. I've always loved science and engineering. I did summer research for 3 years at Los Alamos National Labs out in New Mexico, working on cleanup of nuclear waste. So started my fascination with sustainability, recycling, and the like back then. The last summer after I graduated was 2000. So it was the height of the .com. And one of the guys I played Ultimate Frisbee with said, hey, you would thrive in the Bay Area. He was a Berkeley Law student. So I said, you know what, let's go. I'm young, Southern, 22-year-old girl, changed the world, right? Software was not something I knew anything about and probably still don't know enough about, but definitely, fixated on the environment, clean water, waste. I decided to go work at the EPA labs because I thought that was the place to make real change. It was a frustrating and enlightening experience because it was so bureaucratic and hierarchical, the opposite of that agile innovation role that I imagined I really wanted. So I thought, I'm in the Bay Area, it's 2000, why can't I start a company, right? Let's go meet people in the ecosystem, get to know people in the community, figure out how this all works. But I was pretty naive. If you think about the last few years, we've recognized sort of the biases against female entrepreneurs and young folks. Like imagine 2000, where VCs were 100% white guys with logoed MBAs. And here I am, this like young Southern science girl, excited, approaching them with ideas, draw your own conclusions. And that didn't work out. So I was like, how do I get these folks to take me seriously? So in science, the way you get taken seriously is you go get a PhD. So I went looking for an advisor that was more interested in more than science for the sake of science. It was actually pretty hard to find at the time, but I went to the University of North Carolina, which was a top chemistry program, and I worked for a guy named Joe DeSimone. So if you recognize that name, he's now very well recognized for being the founder of Carbon, which is a multi-billion-dollar additive manufacturing company. which is, I believe, his 5th startup now, but I worked for him when he was relatively unknown. He'd had 1 startup, but he's an incredible visionary. Best storyteller I've ever met. Made me realize research is really only impactful if you can market your discoveries and help connect the dots for investors. So I got to see him pitch companies from the very beginning. I got involved. It was just a learning experience of a lifetime. So long story short, we and another graduate student founded a company called Liquidia Technologies, which at the time of launch focused on plastic chips, kind of like rapid diagnostic technology. But the company fairly rapidly pivoted to drug delivery, so nanoparticles for drug delivery. We had great investors from the Bay Area, from Boston. I love that science-business interface, working with customers, prototyping. Started a separate group focused on material science, which is really aligned with my passion areas. Batteries, solar cells, smart windows, all those clean tech goodies from the late 2000s. Almost became its own company. It didn't work out. Timing was bad. The life science side of our business was going really well. We'd raised, I think, $60 million. We were self-funding the clean tech side, and the crash happened, right? So the execs team said, you know what, we really need to focus on life science, which is totally the right move for the company. It was a crossroads for me. And sort of serendipitously, if that's a word, I was having conversations with a group at RTI called Research Triangle Institute. It was a not-for-profit translational institute. So it's not a university. They only do applied work and not quite a company. So it's a large global organization, about $1 billion in revenue, almost exclusively federal funding. So it's really interesting because the people in the work were extraordinary, but there was no commercialization function. So here I am, this background, startups, and what an untapped opportunity to take this work RTI was doing for the federal government, understand the value for corporates, and maybe partner, license, create spin-off companies. So I had some success landing partnerships, growing our team, built the credibility to bring more entrepreneurial thinking to the organization. Our executive team basically granted me an internal seed fund to sort through all our assets, pick out the ones with value, fund them. It was amazing connecting with the scientific innovators across the institute, coaching them on translating skills to business, validating their work. I loved it. I got promoted to see the engineering functions. And then one day I got a text from a guy named Kip Fry. He was a very well-known local North Carolina entrepreneur and investor. I met him twice at Duke, who said, hey, I'm now doing something really interesting in Indiana. I think you'd make a great VC. You should come see me.
Wow. That was one heck of a Roth rocket ship. So tell me, there were so many different paths to go down here. How quickly did you take to the business side of all of this? Because to me, these sound like almost different worlds when we talk to a lot of hard sciences. And it sounds like you really took to it quickly and built that side of your brain and enjoyed the intersection of these two.
I did. And I think I grew up with it in many ways. So my dad had me going to meetings with him even as a kid. I would be in his booth. I'd be talking to customers. I love talking to people, connecting with folks. I'm an experimentalist at heart, right? All scientists are, but I see the business side as a different type of experimentation. People talk about this in things like lean startup and whatnot, but it is, hey, testing your product in a market is very similar to testing your product in a lab. And I really enjoy that. The new product development, commercialization piece, it's just the idea is only a tiny percentage of what makes it, right? The rest of it is the execution side. It's the team building. It's do you have the right business model? Do you have the right way to sell your product, get it out in the market, et cetera? And you can't have a complete product without all of those things.
So Kip Fry comes to you, says, I think you'd be a great VC. I'm doing an interesting thing in Indiana, living in the Bay Area in early 2000s. What types of feeling did you have about Indiana?
I didn't know anything about Indiana. I had been there once in college for an NCAA event and had rarely visited. I didn't know much about the Midwest in general. I'd lived in North Carolina with my husband and 2 kids for 20 years. I didn't know a single person. It can be kind of intimidating when you think about moving to a city where it feels like most people have lived a long time. They have extended family and a support system. But we came to visit, and the community was just incredibly welcoming. It actually felt a lot like North Carolina. I left the Bay Area after about a year to do my PhD, but it also didn't feel like home to me. It was exciting and invigorating, and there were lots of things happening, but I speak to my desire to have relationships, and at the time, it felt like it was very transactional.
Besides the city itself, what about Kip's proposal was so interesting to you to be able to change everything up and say, yeah, I want to move to Indiana and I'm interested in pursuing whatever this something interesting was?
Sure. And I'd love to talk more about HG Ventures because a lot of it was because the way they set up HG Ventures. But so I wasn't looking for a job, right? I had just gotten promoted to vice president. I thought I was making significant change in a big organization. And I looked at what I loved. I loved the entrepreneurial, the new product development, the commercialization activities. I always saw myself staying there and being like a builder and a doer of companies and products. VC was never on my radar. It never occurred to me that I could be on the other side and be an enabler. When I step back, it's a different scale of impact, right? I'd worked with, mentored scientific entrepreneurs my whole career, maybe my whole life if you throw my family in the mix. And I feel like I can connect to them in ways that maybe a traditional business-focused VC cannot. And so looking at the work the Heritage Group does and could do just aligned exceedingly well with my professional interest and experience and their focus on values, honestly, like big opportunities, bet on people, safety, customers first. It just really aligned with my own.
Had you heard of the Heritage Group before? And how was it described to you that it became interesting to you? Because businesses like the Heritage Group, these family-started, giant but kind of private businesses are often pretty low profile despite their size. And so I'm interested to hear how that was taught to you and how you received it.
Sure. HG Ventures itself launched in 2018 as the corporate venture arm of the Heritage Group. And I joined a couple months after we launched. So the Heritage Group is not well known. It's a 90-year-old, Indianapolis-based, multi-billion-dollar private company. It has operating companies in three main segments: heavy construction and materials, environmental services, and specialty chemicals. It's a private, family-owned business that has seen impressive, consistent growth in this humble Midwestern manner, right? When I got the text from Kip that said, "Hey, come see what I'm doing," and I learned a little bit more about the Heritage Group, they had no website. There was no website for the Heritage Group. They said, "Just come up here and see." And I came to Indianapolis, which was just a really lovely community, and pulled up to this building that looked like it was lifted out of Silicon Valley. It was clear from when I stepped in that the owners and the feel and the vibe and the values were about innovation and putting your money where your mouth is. It's not like we're not going to talk about innovation to do nothing. We are going to actually invest and be committed, right? And so you then step back and say, okay, what are we doing at HG Ventures? There's a lot of things that we can do that are different than a traditional venture firm or even a traditional corporate venture firm because we are private. We have huge support from the executive leadership team. Maybe I'll go a little bit into that in a second.
Yeah, please go into that. I would love to hear more how HG Ventures is structured and when they started that arm of the business, if you understand the history of it as to why they started a corporate venture capital arm in the first place.
Sure. So we invest in entrepreneurs that work in our core industrial business areas, right? Those adjacent and disruptive through this corporate venture arm, HG Ventures, and a Heritage sponsors Techstars Accelerator to support even earlier stage businesses. We are highly sector specific, but generally stage and geographically agnostic. We have a thesis. It essentially says HG partners with entrepreneurs building the future of sustainable materials, infrastructure, and industrial processes. But put very simply, we invest where the Heritage Group can help. So as the corporate venture arm, we leverage the people, the assets, which is really important in hard tech, and the relationship in our operating companies to support entrepreneurs scaling their businesses. So like other CVCs, which is corporate venture capital, we invest off the balance sheet. We allocate $50 million per year to our investments, which would equate to a $350 to $500 million fund in kind of standard fund language. Our process and our metrics for success are more like a traditional VC. We've established a hybrid model. So we're really trying to take the best attributes of traditional and corporate VC and eliminate a lot of the challenges that are there. Tactically, our initial investments range from 1 to 10 million. We can lead deals. We can syndicate with partners. We have resources set aside for follow-on funding, and we can invest in anywhere. But well over half our deals in capital have gone to the Midwest. All are outside of Silicon Valley. We've been extremely active in the last 2.5 years. 20 companies funded and about 125 million deployed. And we've had 19 pre-seed and seed stage companies go through our Techstars Accelerator.
When did HG Ventures begin, and when did the Techstars Accelerator begin?
So HG Ventures began the summer of 2018. And our first Techstars program was run in the fall of 2019. So we built our relationship from Techstars basically from the start. So our ventures group is actually, if you step up to our corporate function, it's called New Ventures. And it's really about innovation and entrepreneurship as a whole. And a piece of that is HG Ventures, which is our fully external facing fund. A piece of that is Techstars. And a third piece of this, which speaks to why the Heritage Group is a piece of why the Heritage Group is interested in ventures, is bringing innovation and entrepreneurial spirit to our companies inside. And so if you look at how we are measured as a group, and we should go into this because corporates are all measured in very, very different ways, but there are things like, yes, return on investment. It's really important, but it's also a set of qualitative criteria that align with the values of this private family-owned business, right? Exposure to market trends, new business models, emerging products and services that could drive future creative thinking and growth. Like, we have now entered the fourth generation of the Heritage Group leadership. So 90 years, the fourth generation has just started. It's a woman named Amy Schumacher. She is a total badass and just sees the writing on the wall. The world is changing. Software's becoming a huge part of industrial. There's all these interesting, very large scale market drivers in climate change, green, moving away from petrochemicals, construction, efficiency, super interesting things that will impact our businesses. And they have the long-term vision and sight to say, we can't do this all ourselves. We'd love to, but at the end of the day, look at how corporations are set up. And now we are a 5,000 person organization that can only run so fast. And look at what startups are doing right now. And we believe that startups will be the future of our businesses.
A lot of times when you hear from these kind of private family-owned businesses, they pitch patient capital or permanent capital, specifically on the acquisition side. I'm curious on the venture side, you talked about all these kind of fun comparable metrics before. Do you have the same kind of 10-year fund horizon, or can you go forever?
We can go forever. I mean, we started in 1930, and while we are first and foremost judged on return on investment, it's not quite the same as, we measure IRR. We want to be a top decile fund. We are aiming to be at least a top quartile fund. We are measuring ourselves like a traditional VC.
Because you can go forever and you don't have the same fund horizons as a typical fund, I was curious how you measure ROI for yourself and your team, even if that's not required by the larger business entity, because you strike me as somebody who very much likes to measure things and be scientific about all of this. So how do you think about ROI on these investments that have whatever time horizon that they need to?
We actually measure ourselves exactly how any other VC would measure ourselves as far as ROI goes. We measure IRR, we look at capital in, we look at our overhead structure. So from that aspect, we are measuring and judging ourselves like a traditional VC. Our belief is actually that accesses to resources that we can give entrepreneurs will generate better outcomes and better returns so they can move faster, scale these unique hurdles that hard tech companies that have more often than with a partner like us that has been there before. But I also speak to the qualitative criteria because this is sort of in the veins of LP management, right? So a traditional venture fund needs to think about managing their LPs and making sure they're happy. And the set of qualitative criteria by which we're measured, again, I said it aligns with the values of this family-owned business, right? Like, how can we develop and grow employees of the Heritage Group that engage with us by giving them knowledge and leadership opportunities outside what they may find in their core businesses? We have employees that have gone on loan to our portfolio companies and participated as mentors in our Techstars programs. That benefits us as an organization, developing our people, giving them new opportunities. And so that makes us a little bit different. But again, like I said, we're a private company we're only on our fourth CEO. We make commitments that last and deeply understand and value the time and effort it takes to build enterprises in our business segments. Entrepreneurs and syndicate partners are always afraid that CVCs have and will and definitely have disappeared when times get rough, but we're committed.
Speaking of different, we got introduced to you because we have been looking for someone who funds hard science type innovation versus just software. What's different about using the VC model to fund hard sciences versus software companies?
Sure. And there are a number of differences. And just so your listeners know, people use the terms deep tech, which refers to companies and innovators building science or R&D based products. We use the word hard tech, which is a subset that eliminates the life science side. So that's where we live. And they are quite different from software. So a couple of different things worth noting. First, the curve for capital needed is completely different, right? Most venture investors, angels, they have a playbook, right? They talk about pattern matching and hard tech patterns don't necessarily fit. LPs have a playbook, right? You can go online and type in a software company, what do I do to raise a Series A? What are these metrics? And there's some industry norms, right? There's the $1 million in ARR, the CAC, the LTV, the whole software metrics alphabet soup. But if you look at the curve for capital in the hard tech sector and the risk profile accompanying that curve, it's completely different. So if you're going to make a piece of hardware, right? The cycle, you're doing an innovation cycle quite similar to software. You prototype, customers like it, you iterate, but then you have to make a huge investment, right? You have to build a factory, a process to scale the technology. And it can be very capital intensive from the start. You're filing intellectual property along the way to make sure that that capital is protected. So you also have to make sure your product is safe and effective before you launch it out into the public. Now, once all that is done, so you've put a bunch of money in, you're making a great product and you're loving it. And the tweaks that are made to that product tend to be smaller, right? In comparison, look at software. You can release a half-done thing and then improve it over time. And to keep selling it, you need to put money in for continuous improvement, right? Compare that to, say, use a specific example, our portfolio company, P2. It makes sustainably produced plant-based flavors and fragrances. I can't release a specialty chemical that partially works, right? It's part of a green fragrance molecule. If I only give you part of that molecule, I could kill you, right? People could get really hurt. And so the company trajectory, cycles, timing, capital requirements differ. A second thing is that there are less VC funds here, right? So there's a combination of structural issues and optics, I think, fuel some LP resistance to investing in hard tech. They perceive this to be, and it isn't different, a high-risk field in what's already a high-risk investment category, right? And they often will question their capacity to source and diligence investments here. So there are a lot fewer hard tech venture firms that are well capitalized. There are a number that are emerging managers, which is very exciting, but a lot of them are under 100 million in assets. They're startups themselves. So I think it's really important for groups like ours with larger reserves. And again, you said more patient capital, market understanding. And the last thing I might mention is that these hard tech startups face some first pilot or sales cycle risks, right? A lot of hard tech companies ultimately sell their products to industrial corporations. You've had Mido on before, right? These companies don't always move at startup speed. In some industries, a single sales cycle can take years, especially one like Mido, where you're going into automotive and aviation that may set specifications 3 to 5 years before a new car comes on the market because of the amount of testing and validation needed. Think about wastewater treatment, selling to a municipality, cities with really low risk tolerance. As an investor, we need to dig into it. When we see sales cycles and revenue projections, we got to be realistic about time and adoption. But there's so much opportunity here. I actually think the opportunity is the biggest here in the Midwest. I am consistently surprised to see the total mismatch between the number of industrial hard tech customers in the Midwest and the number of startup companies. That's why we started Techstars. That's why I'm excited about other funds and ecosystem builders like MHub. The customers are here. There's really big ones. I think M25 said we have a quarter of the Fortune 500 headquarters. Such a strong, diverse economy. And hard tech has moved from being, it's hard and expensive, but it's moving from nice to have to need to have.
This HG Ventures is relatively new, being from 2018 till now. How long was the company planning HG Ventures or researching even how to start a CVC? Because you mentioned, we do things differently than a lot of CVCs, which means that there must have been some research done on how this is typically done and ultimately modeled for how you guys did it at HG Ventures. So I'd love to hear a little bit more about that process.
So my boss likes to say that HG Ventures was started because of Duke basketball, which drives me nuts because I'm a Carolina girl. And if you're from North Carolina, you got to pick your team, right? So the third generation CEO, Fred Fazenfeld, is a huge Duke guy. And he and my current boss, Kip Fry, are the type that invest heavily in Duke basketball. They go to every game. So they've been part of this Duke basketball community for years. And I would say it happened pretty quick. Early 2018, Fred comes to Kip and says, hey, I have this little company in the Midwest, and I'm thinking about starting a venture fund. And I know You have a long history in venture. Like, how might I set that up? And so they sat in a hotel and just sketched out what was going to be HG Ventures in a matter of an hour or two. And Kip gave some thought to it, went away, gave some thought to it, and said, hey, there are these things that you can do as a private company that normal CVCs can't do. And oh my gosh, this is really interesting as a traditional VC because it's like a single LP, right? And so the investors in the CVC arm don't have to spend all this time fundraising. And so think about all the impact that a CVC can bring to the ecosystem that you already work in. And so they said, okay, here's all the great things about CVC. Here's all the great things about VC. How do we merge those together? And Fred says, how much money would you need? Did some math. They're like, how about $50 million a year? I was like, all right, do you want to run this? Yes. And I'm going to bring my colleague, John Glusiak, who I've worked for 25 years. And a couple weeks later, they texted me and HG Ventures got started.
You mentioned the cost to start a startup in this space is a lot higher because there's just you have to set up manufacturing. You have to do all of this stuff that you don't have to do in software because you can kind of iterate more in software. I think about kind of software in the 90s and how it cost, $5 million to really get kind of software up and running because there wasn't all of this infrastructure around. And now today you can launch an app on your phone using no code. Do you see any similar trends in the hard tech space? Are there people who are building infrastructural components to make it easier for other hard tech companies to launch and scale quickly? Or do those already exist?
I believe the market is moving more in the sense that the hard tech market, that you don't necessarily have to build a giant factory to make your thing. There's a lot more folks relying on what's called toll manufacturing, where you can sort of rent a facility for a small period of time. There's also a really interesting movement in the change of business models happening in hard tech, where two pieces to that. One is on the capital side, where historically people have thought about economies of scale, right? Where you have to build this huge factory, bring in all of the the infrastructure in place so that you can make an economical product. And now people are tapping into what I would call the economies of mass manufacture. Can you take things like a car engine that's made at large scale fairly cheaply and use that to run a much, much smaller factory, decentralize it all, and put it on site at a location? Like, for example, if you have a wastewater treatment, you're making microelectronic chips. There's nasty stuff that comes out of the back door. A lot of times it's put into a truck, driven down to one of our facilities in the middle of Indianapolis and treated there, right? Why not have, and there are people that are starting to do this, small scale treatment plants that are located right on site, right? So how do you take these giant economies of scale and shrink them down so that the economics work and the footprint works and it's smaller, more interesting? It also works on the other side of the supply chain, right? I need hydrogen to make my specialty chemical, right? Rather than making it this giant plant where you're taking methane, you pull hydrogen off and you truck it across the world. Can you make it just right there on site by maybe tapping into a natural gas pipeline or something? And again, using a small piece of equipment. That's super exciting to me. The other side is business model innovation, right? So if you think about this, if I am selling to a large industrial customer a piece of equipment that may have to go in their plant, right? It might be $1 million. It's not $50 million plant that's huge and centralized. Maybe it's $1 million. And that's still a bit of a hurdle for folks. And so I see hard tech innovators starting to iterate on a business model and really pulling from the software business model side, where they're like, you can rent this piece of equipment over periods of months, leasing hardware as a service per se, where you're getting the cost of capital and spreading it out over a number of years, but having people sign up for much longer term agreements, if that makes sense.
How do you think about founder versus product market fit? In the startup world, the typical startup world, a lot of early stage investors will say, we bet on the founder 100%. With the backing that you guys have, does that change the calculus at all with all the capabilities that you can bring to bear? How much you worry about the founder versus the fundamental business innovation?
It actually doesn't. When we diligence startups, we look at things almost the same way another investor in another segment might be, right? Team and founders are still our number one. Then market, then technology. Now the founders are different, right? We're looking for things where, we still want that relentless pursuit of success, balanced with like not being married to their specific technology solution. You see a lot of relentless founders, but they're totally enamored with their solution as being the best and not listening to customer feedback. I think we run across that a little more often. I think we need to look for heavy self-awareness in these groups, understand where their limitations are, because sometimes you can get a little bit of, hey, I know everything type of thing. We also need to look for their vision, articulation, and ability to tell a story. And so while it's a team, I think there are different things that we tend to look for, because it's more common that a scientist CEO is there, and do they know their strengths and weaknesses? Can they hire and surround themselves with people who know things different than what they know, where they may have gaps, right? Can they tell a great story, the big picture, attract talent, bring on customers, attracting investors? And then another piece, are they part of a community, right? Outside the scientific world. So networking is incredibly critical. You guys know that as well as I do. Peer mentorship is so valuable. You can build that. And so we look for probably different attributes in our founders, because we see where people tend to get tripped up. But absolutely, the early stage technical founder is a major part of our diligence and selection process.
How do people think about pricing in this industry? I feel like in the software world, it's, hey, you're growing 100%, or you hit the rule of 40, here's a 10x revenue multiple and be gone. Not always, but there's a more simple way to value things because there's so many startups and so many funds. How does pricing and thinking about valuation work in the hard sciences?
I would say that the way we look at valuation is, like you said, you can't do a multiple on something, because 100% of our businesses are EBITDA negative, right? Yeah, the revenue is very, very small, if nothing. So we are looking at the slope of the line in terms of traction in many ways, like who's in their pipeline, how long does it take to get there? And we're doing a lot more modeling, seeing if we believe when revenue will happen and at what scale, because we know these markets really, really well. We do a lot of comparisons. I'd say that's probably our number one factor in valuation, is what are the comparable companies in the sector. And there's not a lot. I mean, it's not like in software where I could have thousands of companies. And like you said, there's norms, but there are similarities, even if they're in different segments. And so valuation is always a hard answer, but particularly hard in our businesses. And I would say comparison and slope of the line and where they are in the maturity of their technology versus where they will get to sort of a tipping point in revenue and customer adoption are all go into the equation.
With a little bit of time we have left here, I would love to hear a little bit more about what it takes to partner with Techstars or bring a Techstars Accelerator to an area, because that's probably a big game changer for that area in Indianapolis to have that type of accelerator there. And my understanding, these types of partnerships are basically backed by the company. So can you talk a little bit about that decision and what that mechanically looks like to make happen?
Sure. So we made a 3-year commitment, which is the Techstars Commitment, where we, through HG Ventures and the Heritage Group, funds the Techstars program that runs for 3 months. We jointly hire an on-site leadership team. So we have 2 individuals that are full-time here that are Techstars employees. Techstars brings the infrastructure, the programming, the brand, which is important for us, and the global network, right? We bring our deep market knowledge, our technical expertise, right? So as part of this, the partnership between the Heritage Group and Techstars splits the equity. Each company gets $20,000 and the option to take a $100K convertible note, which also gets split. And if you look at why we want to have this accelerator on site, it's a lot of the reasons, or it's similar to the metrics by which we as a ventures group are measured, right? Let's increase the absorptive capacity. Let's expose our organization to these market trends and business models and emerging products and services. It gives us a pipeline, right, as ventures for future investing, for financial return. Can't forget that, right? Partnering for strategic benefit. It's like the opportunity to try before you buy in some ways. There's that development and growth of heritage employees. Again, they bring their knowledge and leadership opportunity, and leadership to these startup companies, but they gain too, right? The startup companies gain and we gain through our employee development. I think it helps us grow our brand and our reputation. We started talking about, hardly anybody knows who the Heritage Group is. Through partnership with Techstars, we are elevating our brand and our reputation in this fairly small ecosystem of industrial startups. And as a family-owned business in the Indianapolis community, there's a lot of thought and like careful thought and consideration given to how do we benefit the communicating, with companies like Mido, ATOS locating here from where they were, companies from our previous group, Material Evolution, Pretread, thinking about, which are from Colorado and from England, thinking about putting facilities here, bringing global startups here to the center for other groups to engagement and benefit from. That's our side. That's why we're excited about it. If you look at it from the company side, there's a lot of choices for startup companies in terms of accelerators and funding partners. But there are very few accelerators that are supported by a company like THG with like this deep market and technical experience and access to a professional investment group even. It's a really interesting and powerful combination, right? I talked about how startup companies in our sectors face challenges around winning their first pilots and risks with sales cycles. These companies are trying to sell their products to large industrial companies, but one of the goals of the partnership between the company and the Heritage Group is to provide these opportunities for pilots. This is a first use case to speed adoption from who did it first, right? We can do it for them. But then the work begins, right? The corporate mentors have to dig in with the founders. It's not easy because these are very early companies, but it's a two-way street, right? Startups learn from us and other brands in our network, and the corporate veterans can see the value of, doing more faster, if I use a Techstars term.
Do companies ever have a fear or a worry that if by working with HG Ventures, I either get locked in and can only work with HG Ventures companies, or what if my company doesn't make it? And if I couldn't make it in this system, how will I ever go out and get another pilot outside of this ecosystem? Has that ever come up?
I would say it comes up more on the investment side because, after my experience as an entrepreneur in the CVC world, CVCs are, yes, a powerhouse asset class and can provide tremendous value, but there's bad actors. And I think there's still a historical bias either within Techstars or within investing that we have to acknowledge and actively work to change, right? But we're not tourists playing VC. We are committed to it, right? There's complaints like corporates have vested interests, right? There's different incentives and different expectations. It's highly likely that the corporate could value their core business more than your growth. That's something that we have to acknowledge and pay attention to. M&A. Our M&A function, we do have an M&A function. It's very, very focused on our core business, right? But you need to pay attention to that as a startup. Is M&A a desirable outcome for the CVC group? Then they're going to want to keep the valuation low. They're going to only pilot things in certain ways, right? If it's a public company, they have to report back to the shareholders. They're freaking slow, right? Often corporate groups need to prove business unit alignment. It's a nightmare. I can tell you stories about, one of my startups working with a $100 billion chemical company. Turns out they needed CEO approval for a $2 million investment. Good Lord. But then you go back to HGV and how are we trying to get around those fears? I tend to be a very authentic person. I was like, ask me any question that you want. There's no question that's out of bounds. 0 questions out of bounds. And good thing I'm saying that at the end of this interview, right? But we try to show them, on the investing side, we're set up as an independent LLC, right? We have independent decision-making authority. And for any startup that's thinking about working with a corporate, you really, at the end of the day, need to find out how are they measured and what does success look like for them. I say that's the number one most important thing because sometimes it aligns and sometimes it doesn't.
Well, Ginger, this has been fascinating. I might take you up on that and have you come back and talk hard tech again because I still have so many questions asked. But if people want to know more about you, where to find you, where to go to find out about Heritage Group or Heritage Group Ventures, where should they go?
Well, you can connect with me on LinkedIn. I'm very active on LinkedIn. I am on Twitter at Ginger Rothrock. My email is grothrock@hg.ventures. Our website is www.hgventures.com. And from there, you can link over to the Heritage Group. So definitely check us out.
All right, Jay, we just spoke with Ginger from HG Ventures. We learned a little bit about something out there.
That's your takeaway? We learned a little bit about something there. We learned a little bit about a lot there. I actually really love having these conversations with corporate venture capital arms, especially when they have this level of backing. It's insane to me that this guy went to a Duke basketball game, met with Kip Fry, and said, what do I need to do here? And they did some napkin math, and they're like, $50 million a year? Done. What? That's crazy to me. And the life cycles of these companies, the amount of investment we're talking about to put into these things to get them up and running, it's just operating at such a scale where you're thinking about numbers that are just such a stepwise larger than anything I've ever thought about.
And it sounds like the way the company's structured, and I'm not super familiar with the Heritage Group, but if it's fourth generation, they're talking about it like a family business. It's almost family office-y in style as well. It's like a mix of these two things. They have this operating business. They have 38 operating businesses underneath that. They have different ways that they invest. So it's kind of like a family office. It's kind of like a company corporate venture capital arm. It's a little bit of both.
Amy Schumacher, the fourth generation CEO, is Fred's daughter. So it has been in the family the entire 4 generations.
Amy Schumacher and Ginger Rothrock, 2 just phenomenal names, just A+ names.
Phenomenal Midwest names. Ginger mentioned that every company they've invested in has been outside of Silicon Valley. Now, they are geographically agnostic. I didn't get a chance to ask this, but it sounds like, they didn't give me the sense that they will only invest outside of Silicon Valley. But it's interesting to note that all of their investments have in fact been outside of Silicon Valley, which probably speaks to the nature of this type of business.
You and I talk a lot about founders starting on second base, Jay, and this feels like one of those spaces where it would be very hard to just have an idea and get it launched. It feels like you have to kind of know how this old legacy infrastructure, construction, heavy building equipment, you have to know how the world operates out there. You can't just say, oh, I have an idea for incremental process improvement in building materials procurement and then launch that. There's definitely a start on second base. So because all these companies, not all of them, but a large percentage of them are headquartered in and around the middle of the country, in and around the major transit areas like the Mississippi River, I would assume that you have a lot of companies that spin out, a lot of ideas that spin out of those companies versus here's a pie in the sky idea that I just came up with and we're going to run with.
I have 2 more thoughts that I want to present here in order because they're connected. The first being working with a venture group like HG Ventures. If I'm building a hard sciences company that could serve their portfolio companies, just seems like such a slam dunk, quick opportunity to really grow my company. And I'm trying to think through what are some of the challenges in doing that or the trade-offs in doing that, and she kind of mentioned some of them at the end there about sometimes incentives aren't aligned with corporate venture capital. And I worry, like, does this lock you into only their companies? But man, it sounds like such a almost cheat code to build the company that you're trying to do, to work with a group like this. The model to me makes a lot of sense, but I wanted to hear your thoughts.
Yeah, I think the holding company model makes sense. And we talked to Jason from Koch Disruptive Technologies, which is the venture arm of Koch Industries. Similar style of company, a lot bigger than the Heritage Group, though they're both gigantic by any measure that you and I are familiar with, Jay. And I think that our takeaway was similar in that because there's so many stakeholders on the company side, there's so many different companies, it's probably a little bit more decentralized than if you just went to a company that had one brand, one thing, like a Boeing. Boeing's job is to make airplanes. And if you get investment from Boeing, you're probably going to be in the Boeing ecosystem. The space isn't wide enough. There's not enough competitors for you not to get sucked in. So here, I think there's a little bit different system dynamics.
And they do call out on the HG Ventures website, we apply strict confidentiality policies and procedures to protect private company information. All proprietary information is secured within a small, defined group of HG Ventures professionals and is not shared with others in the Heritage Group unless authorized by our entrepreneur partners. So they understand that risk, right? But the second point that I wanted to make then to follow up on that, when we talk to people like Ginger or like Jason, I reminded how just everything is run by people. And it doesn't strike me that Ginger, Jason, anyone we've had on the show is completely inaccessible. And so it gives me excitement that moving forward in my life, whatever I'm doing, if there's somebody within a company that can like really fundamentally change the trajectory of what I'm doing, they're probably not that hard to reach, and it's worth trying.
The classic J. Klausism that I think about whenever I send a cold email is access is easier than it seems. And I think that's definitely true in venture. It's true in life in general. So yeah, taking this kind of high level there, Jay, but I agree. It's inspiring.
Amazing. Well, we'd love to hear what you think about this episode, dear listener. You can tweet at us at UpsideFM or email us hello@upside.fm. And we'll talk to you next week. That's all for this week. Thanks for listening. We'd love to hear what you think about this episode, so tweet at us at UpsideFM or email us hello@upside.fm and let us know. You can learn more about us and browse our entire back catalog of episodes at upside.fm. And if you love our show, please leave a review on Apple Podcasts. That goes a long way in helping us bring high-quality guests to the show.
Rocky and Sylvester. One for underrated, two for underpaid. Today I'm gonna get it, and there's nothing in my way. About time. I've been out here for a minute, waiting for my chance.